Here are two reasons why Starbucks is struggling. Starbucks' empire is 50 plus years old, but recent developments pose questions about its strategy. Here are the two reasons that I see. What do you think? What are your reasons? First, the ambience feels too standardized. And number two, the waiting time is just too long. Welcome to this Valuation Masterclass case study. My name is Andrew Stotz, and for over 30 years, I've helped thousands of finance professionals master company valuation in months, not years. In this video, you're going to learn the two reasons that I mentioned, the effectiveness of Starbucks' competitive advantage, and Starbucks' attractiveness on my global stock tracker. Remember that you can click the link in the description to get this presentation as well as the global stock tracker of the top 500 companies for free, delivered every Monday. So what's the background on this company? Well, of course, Starbucks is a global coffee giant that redefined experiences, culture, and connection. Do you know the science behind getting your name written on a coffee cup? Well, it first comes from The Power of Habit by Charles Duhigg, and he talked about creating a habit loop. So what's the cue? You enter Starbucks and you give them your name. What's the routine? Order, wait, hearing your name, and then what's the reward? You receive a personalized cup and enjoy your drink. But it's also related to another book, Contagious, another great book. And this book, talks about how to make things contagious. And he says, basically the name writing that they do at Starbucks encourages social sharing and virality, especially when they misspell the name. People share it. So there's also books like Richard Thaler's Nudge and Seth Godin's Purple Cow that also highlight what Starbucks is doing with the name. Now, beverage is the main revenue driver for Starbucks, accounting for 74% of total revenue. 23% comes from food and a little bit from other items. Now, United States, of course, is Starbucks' biggest market, making up 74% of its revenue. The next biggest market is Japan, Canada, and UK. So they look at those developed markets. And then we have China as a separate market at about 8%. So there's a lot of room, right, around the world for more Starbucks. But being so reliant on the American market, any slowdown in America is definitely going to hurt Starbucks. So let's talk about those two reasons, right? Reason number one is Starbucks' ambience feels too standardized and it lacks uniqueness. In fact, the new CEO, Brian Nichols, says the Back to Starbucks plan aims to save Starbucks from its decline. Here's what he said. The reality is the majority of what we have are these cafes that I think don't have the right seats, potentially have the right texture, but don't have the right layers. They don't have the right warmth. We need to bring that back. In other words, get people back into a Starbucks. I don't know about you, but when I need to sit down and do some thinking and some writing in a relaxed sort of place, I go to a Starbucks. Now, the successful strategy of global expansion actually has its seeds of its own destruction in it. Starbucks' global expansion has led to uniform store designs, similar layouts, consistent branding, making many locations feel interchangeable rather than unique. So, in fact, what you could argue is they've focused on efficiency over community. Starbucks has become more focused on efficiency, like mobile orders and quick turnover, reducing that cozy and community-driven feel. Also, there are amazing independent coffee shop options around, right? The rise of these independent coffee shops with unique designs and local characters make Starbucks feel generic and less distinctive by comparison. Customers are talking about this decline, right? Reviews, I was just looking at some reviews on platforms like Reddit or Yelp, often describe Starbucks as too corporate, generic, and lacking soul. In fact, longtime customers have noticed that stores now feel more transactional than inviting. In fact, here is a Reddit user comment. It says, quote, former partners say it's so different now. Baristas cared more in the past because the company cared more. It wasn't so corporate heavy, unquote. Now, reason number two is the waiting time is too long. The average wait time for Dunkin' Donuts in America is 1 minute, while it's a bit over 4 minutes for Starbucks. And the surge, of course, in mobile orders is causing delays in in-person service, impacting overall customer experience. I've always wondered as I went into stores like Starbucks and others that are taking a lot of online courses, online mobile orders. How are they managing this? How are they not getting completely overloaded and the customers in the store are just getting backed up, right? And so baristas receive up to 7 mobile orders per minute, causing delays in the in-store customers. This comes from Business Insider, and Business Insider also noted mobile orders allow unlimited drink modifications, and that slows preparation times. And then in-store customers feel neglected as mobile orders are prioritized. So what's the company's response? Well, Starbucks is testing ways to limit mobile orders during peak times to reduce delays. This is coming from reporting from Reuters and Bloomberg. So to summarize, Starbucks, it's a global brand for sure. It's got refined experiences, culture, and connection. But the company's overhaul plan aims to deal with the 2 reasons that I mentioned that Starbucks is struggling. So what about the company's competitive strategy? Well, Starbucks has 400,000 employees and 27 billion in revenue. And it's in the consumer discretionary sector. And of course, the main segments and the main business line is coffee, Frappuccino, and then Starbucks Reserve Roastery and the Reserve stores. Those are the 3 main areas that are generating revenue. So what is the company's competitive advantage? Well, it's been built through strong brand loyalty, premium coffee experience, and global expansion. So how did they achieve it? Well, by creating a unique coffee house atmosphere, focusing on high quality beans to a limit for the great coffee drinkers out there. We may argue with that, but providing personalized customer experiences and building a strong brand presence through franchising and company owned stores. So Starbucks use, of course, only Arabica beans for their superior quality and complex flavors. Vertical integration is Starbucks' strength, managing and controlling nearly all operations from, of course, they don't grow coffee, but they do have a source of coffee supply, and then they roast, and then they have their own coffee shops. So Starbucks continues to expand globally, balancing company-owned and company and licensed stores. Right now in North America, there's about 18,000 stores, and outside of the US, it's about 22,000. So more outside than in as far as stores are concerned. Of course, the revenue is more generated in. Now, in 2024, there were 40,199 Starbucks stores in the world. So product differentiation and innovation help Starbucks stay relevant. They've got many different types of drinks now out there. So what's the company's competitive strategy? Starbucks created a competitive advantage through strong brand and premium coffee experience and global expansion. And Starbucks made it possible through product differentiation, global expansion, and vertical integration. But does this strategy lead to a competitive advantage? I use my world-class benchmarking scorecard to measure if a company has a competitive advantage. I developed this scorecard 10 years ago, and here's how we construct it. My team gathers the yearly and quarterly financial data of 26,000 companies worldwide. We then calculate each company's profitable growth score, which is a composite measure of both profitability and growth. After that, we rank the company relative to sector peers of similar size, and a decile ranking of a 1 or 2 is financially world-class. We assess the company's performance over the prior 4 years and the past 12 months. So is Starbucks financially world-class? Well, the answer is absolutely yes. In 2021, 2022, 2023, and the past 12 months, Starbucks has delivered world-class financial performance when compared against 940 consumer discretionary companies worldwide. Now, Starbucks revenue growth was consistently in line with the global sector average, but in 2024 is when it really fell down to 1% versus the global consumer discretionary sector growing at about 13%. And Brian Nichols suspended new store openings to prevent dilution of pre-store revenue. So how does the valuation look? Well, let's go through the global stock tracker for Starbucks. First, Starbucks share price is about the same level as where it was 5 years ago. So no progress over 5 years. That sucks. So let's apply my global stock tracker to assess the attractiveness of the company. Here, I look at first fundamentals, and we can see that if we look at Starbucks' net profit margin, it's about 10%, which is below 16.6 for other large cap companies in the industry. So below average profitability right now. Tim Hortons and Dutch Bros rival Starbucks with affordability, speed, and unique customer appeal. Tim Hortons is a Canadian coffee chain known for affordable drinks and fast service, and it's owned by Restaurant Brands International. And there's one right down the street from me here in Bangkok. And Dutch Bros is a US-based drive-through coffee chain known for its customizable drinks and community-focused approach. Now, Starbucks is far behind RBI and Dutch Bros in terms of net profit margin. Starbucks' net profit margin is about 10% in 2024, and we can see that RBI is about 16% and Dutch Bros is 25%. It just shows what profit potential is there. Of course, Starbucks had that profit potential in the past, but now it's been weaker. Now, there is above average asset utilization, which is keeping ROA strong despite the lower profit margin. In fact, the return on assets for Starbucks is 12.8 versus 11.7 for the industry group. So because they get more revenue out of each store, their ROA stays strong. Let's now go from fundamentals into valuation. Here we can see that the PE ratio of Starbucks is about in line with the industry group at about 30%. So it's not cheap, but it's definitely not expensive. On a price to book basis, we can't really look at it because it has negative shareholders' equity because of share buybacks. So with share buybacks, there's an accounting entry that causes equity to be negative. Now, in countries like Thailand and many others around the world, the government doesn't allow the company to show a negative equity item due to share buybacks, but in the US, you can. So while building so let's go on to the next one, momentum. Here we can see that EPS momentum and price momentum is what I'm looking at. So what we can see is over the past 3 months, so quarter on quarter change, the industry group was up about 63%, incredible performance. Starbucks was down about 8%. And EPS CAGR from 2016 to 2024 was 9%, which is basically in line with the 8% EPS growth of the industry. And in first quarter, global sales were down 4%, with China down 6%. Operating profit was down a whopping 25% due to store expansion. And there was 377 new stores totaling this 40,600. Remember that it's 53% company owned and 47% licensed. And there's 35 million US rewards members. That's the card that they give out, which is up 2% quarter on quarter. So price momentum is in line with the industry, and the market's not buying the turnover yet. So the share price is up about 1.6% over the past 3 months, and that's about in line with the industry. Finally, let's look at the FVMR, the R in FVMR, and we can see that the net debt to equity of the industry is minus two times, let's say, and that the net debt to equity for Starbucks is minus 1.4. In other words, they're net cash companies. And the reason why they're net cash companies is because they don't give credit terms, right? They're retail and people pay cash. So there's about $3.7 billion in cash and $14 billion in debt, meaning 37% of assets are financed by debt. And finally, steady business produces a low beta. The beta of Starbucks stock is about 0.5 versus about 0.9 for the industry. And just to give a comparison, the company DoorDash is much more volatile at 1.7 times beta. So remember to click the link in the description to get this presentation and my global stock tracker of the top 500 companies for free. And these are the 2 reasons why I think that Starbucks is struggling. What are the reasons that you think? You think they can turn it around? Let's see.